Thank you for holding on right till the end. I believe I'm the last presenter, so appreciate that. I have a very limited amount of time to explain what is a very complex fund, so forgive me if I'm a little bit quick on some of the slides. I will try my best. So, HVPE is a listed investment company, very similar to an investment trust. We invest exclusively in private companies. So we do that via a number of HarbourVest funds. HarbourVest is our manager. HarbourVest is a US private market specialist, so does nothing but invest in private companies in various ways. And we're the largest, what's called listed fund of funds in private equity. So we invest into HarbourVest funds that in turn invest into the funds managed by some of the leading private markets groups globally. And I'll explain a little bit more about how we do that. But we have a portfolio of just over $4 billion. So as I said, we have the scale. We're one of the largest funds. We also have a very diversified global portfolio. So we have more than 1,000 private companies of material size in the portfolio. In some ways, and this is a slightly unflattering comparison, but in some ways, we're akin to an ETF for private markets, almost like an index fund. But we have a track record of selecting, the better quality companies within the market. So we are ourselves a member of the FTSE 250, for better or worse. Sometimes there are benefits to that when demand is strong and there's lots of buying. When the UK is out of favour, as it has been in recent years, that can be a bit of a challenge, actually. But we are the 64th largest company in the index at the moment. The share price total return over 10 years, just shy of 200%. It does move around every month, of course. An important point here is, we are making long-term commitments to the HarbourVest funds. So typically our funds are 10 years in duration at the underlying portfolio level. And that means we have an orientation towards that long-term horizon. So looking at our performance in share price total return, which is, of course, what matters to investors, we are actually in the top decile of all investment companies that have a 10-year track record. So we're 25th out of just over 250 funds. The basis for that, of course, is the performance of the assets. So in US dollars, we've compounded capital by 13% per year over the last 10 years. That's net of all fees, I should add. And that represents outperformance of more than 3 percentage points per annum of the FTSE All World Total Return Index on a gross basis. So that tends to range between 3 and 5%. We are at the lower end of that historical range at the moment because public markets have performed so well recently, and our net asset value tends to lag public market movements. So a bit on the structure. I won't spend too long on this, but essentially we invest in 3 different ways. So the HarbourVest funds are either primary fund of funds vehicles, which make commitments to new partnerships raised by the likes of KKR, Carlyle, EQT, Index Ventures, all the best known kind of global groups. So those funds call capital very slowly. We make commitments up front, and they're drawn down over many years following the commitment. And that means we're averaging into the market. We're not trying to time the market in any way. We're continually investing kind of year after year. In terms of the secondary funds, which are 30% of NAV, those funds are more opportunistic. So that's where a HarbourVest fund is purchasing stakes in underlying partnerships, so the same sort of structures managed by the same groups, after they've finished raising, after they've started to invest. So we're buying actual portfolios of companies, often at a discount to net asset value. And then finally, 20% is in the co-investment funds. So they're investing alongside the primary and secondary products into companies that are brought to us by some of those same general partners. So they will bring us an opportunity to invest in company X. We can decide whether or not to proceed. The result, though, is a very diversified range of companies. So as I said, 1,000 material private companies around the world. So what are some of the benefits of private markets exposure? I think it's a fundamental point to clarify and hopefully to encourage you to think about. There's a whole world of private companies out there. The public equity markets have been shrinking significantly over the years. So in the US and in Europe now, the number of public companies is about half what it was 30 years ago. So there's been a de-equitization trend. I think many of you will have seen and maybe even held shares in companies that have been purchased from the public market. That's a growing trend. And also, less obviously, there are lots of companies you never see on the public market because they don't IPO. Nowadays, they're much more likely to remain private in the hands of the sort of managers that we invest with. So one of the key benefits, one of the reasons for that, frankly, is public markets can be quite short-term in nature. We see evidence of that, that when a company struggles for a year or two, there's pressure on that company. In a private equity or private market structure, you see a much longer-term time horizon. The funds are 10-year vehicles, as I said. So the alignment of interests is strong between the private equity manager and the managers and the owners of that company. In buyout investments, where the private equity manager takes a controlling stake, they are essentially one and the same. They are the owner and the manager of the business. Performance clearly is a key reason to look at private markets. We have some figures there, just kind of industry data, looking at buyout funds only. And you can see we compare those returns on an annualized basis to the MSCI All Company World Index. So over varying timeframes, 5, 10, 15 years, you see the strong outperformance. And then the chart on the bottom right there, the number of private equity-backed companies has multiplied by 7. So about 4,000 in the year 2000, up to 28,000 today. So the trend in public markets is firmly down, or certainly has been for a long time, and the trend in private markets is firmly up as the industry keeps growing. So why HVPE? There are lots of other ways to access private markets. Although the listed PE sector in the UK is relatively small, there are really, I would say, 10 funds of significant scale in the market of varying types. We are the most diversified, so you might argue in terms of risk profile, we are probably at the lower end of the market, but our returns are near the higher end. We've beaten the majority of other funds, even the more concentrated direct portfolios. We have a unique structure in our fund of funds approach in the way that we invest. And to support that and to maintain a fully invested position, we have a credit facility on the investment company itself, which is one of the benefits of the investment company model. So we have $1.2 billion available, and we're currently drawn on a net basis by just over 300. So that gives us flexibility to get us through periods of weak cash flow, like we've seen in the last 2 years. And I will talk about this more, but we're starting to see that trend reverse. So we're starting to see positive cash flow every month, which is clearly likely to be a tailwind for the performance of the portfolio. I'll touch on a couple of others. So we listed in 2007. So to be clear, we focus on the last 10 years, but I'll also give you the numbers since we IPO'd. And remembering, and I remember this very well, as I was just starting my career at 3i at the time, but the financial crisis just hit at the end of 2007, and that moment in time was really a peak in valuations. So just by bad fortune, I suppose, we ended up IPOing at that time. I wasn't with the firm then. But since that peak in 2007, when clearly we had a really historic boom in most areas of the capital markets, we've actually returned a 4.4x overall for shareholders. So despite the current discount to NAV, which I'll talk about as we go, the return has still been very strong. So I will just focus on one more of these tiles. So the discount to NAV at the moment is 40%, which is, compared to most other investment companies, very wide. It's a source of real frustration to the board and to HarbourVest as a manager. We did institute a policy to try to address that in February of this year. It hasn't been operating very long, but we have deployed significant capital into share buybacks to take advantage of that discount and deliver a net gain in net asset per share for continuing holders. And I won't spend too much time on it. Again, it's a brief presentation, but essentially we ring-fence capital every month. Cash that comes in from maturing investments, 15% of all of that cash, with no deductions, is allocated to a distribution pool that the board can then deploy in share buybacks or any other method that the board decides. So you'll see at the moment, we're buying back a run rate of about $10 million per month of shares, and that's clearly likely to be helpful to returns going forward. So a few words on HarbourVest. Why invest with a manager like this? And you may not have heard of HarbourVest. It's not a particularly well-known name outside private markets. We're clearly trying to change that. But it's a very established group. It's regarded in the industry as something of a blue chip name, established more than 40 years ago with a very large team, nearly 1,300 employees across 14 offices, all dedicated to managing the assets that the listed company is invested in, alongside about $130 billion of other client capital that the firm manages. So it's important to remember this is a firm that's way beyond the UK. It's way beyond the investment trust world. It's a very large private markets business. We have relationships, and by we, I mean the manager, with thousands of underlying private markets managers around the world. So there are 10,000 groups in existence who specialize in private markets investing. We know most of them. We invest with around 1,000 of them. And we are highly selective within that in terms of the products that we invest with in each of those groups. We've built up in the last few years a quantitative investment science team. That is a real differentiator. So we apply as much science as we can to the investment decision-making process. So we're not just reliant on relationships and discussions with underlying groups. We do assess their performance in a very objective and sophisticated manner. So that's a real differentiator. We have data on more than 70,000 private companies, current and former investments, for example. So that's gives us a real edge in the market. Now, a word on market conditions, and this is changing almost daily, I have to say. Private markets are highly adaptive. Most of the leading private equity managers today were set up in the 1980s and 1990s in what was clearly a very different environment, but notably an environment with higher interest rates than we have now. And those groups established a reputation for delivering strong returns in that environment. We've been through a lot of upheaval in recent years, and I think that's kind of shaken confidence to some degree, certainly among public market investors in private markets portfolios, because it's very difficult for public market investors to really second-guess the valuations of private businesses. But there is a huge amount of work that goes into valuations, and we're starting to see, the portfolio has been very resilient for the last 2 years. As I said, it tends to lag in both directions. It lagged public markets on the way down. It's very likely that there's some latent value in the portfolio today as public markets hit new highs. We have seen low distribution levels, as we call it, so cash coming in from maturing investments and sold investments. That is starting to change. I think the last 2 years really have been, historically unusual in that respect. The last time we saw that sort of environment was post-financial crisis. So we're increasingly confident that liquidity in the portfolio is improving. We're starting to see more profitable exits come in, which will in turn provide more fuel for the distribution pool and hence for buybacks. So we could be set up for a virtuous circle here that there's more confidence in the NAV, there's more liquidity coming off it at a premium to NAV. We tend to sell investments at an uplift to carrying value, and in turn, that will support demand for the shares through the distribution pool. I'll skip that one because it's very complicated and I only have 5 minutes. Okay. So a quick note on what's in the portfolio. As I said, we're a global fund. We try to invest through different strategies because they tend to perform well at different points in the cycle. So a classic example in the last few years is venture and growth equity. So we have 30% of NAV in that strategy. I think you could say it's out of favour in terms of sentiment, but actually the portfolio companies have continued to grow very rapidly. We've seen revaluations of the portfolio companies, but the fundamentals seem to be intact. We're seeing revenue growth upwards of 50% per year in many companies. So that performed extremely well in 2020 and 21, and less well since then. But over a 5-year period, it still has outperformed the buyout portfolio, which is the real bedrock of our fund, quite significantly. So there's been a real benefit to having that in the portfolio, and actually we're starting to see from the Nasdaq being up 40%, for example, there's a real return to positive sentiment in that part of the market. But we're structured to try to deliver even annual NAV per share growth, so we don't want to have spikes and then troughs. We want to try and deliver a very steady and comfortable experience as far as we can. So we do have some private credit and infrastructure in the portfolio that helps to offset the volatility in the venture and growth equity assets. In terms of geography, we mirror, kind of roughly mirror, the FTSE All World Total Return Index, a global stock market index. So we're not trying to be clever in terms of geographical allocation. We don't tend to make too many changes to the structure of the portfolio. We're really trying to optimize the returns through our selection of investments and the way in which we deploy capital. By sector, we're well diversified. We have an overweight to tech and software as a result of the venture exposure. I think that is, I'm sure previous speakers have given some insight into that as well. It is well placed right now to continue to lead in the years ahead, so we're very comfortable with that overweight. Long-term performance, this kind of illustrates better than most charts, I think, the share price discount and how it's widened out in recent years post 2022. We would say this historically has represented an opportunity. Whenever the discount to NAV trades at around 40%, the subsequent 3-year performance in the shares on average is 90% positive. So, if you just go on previous trends, it could be an opportune moment. And as I said, we believe that the fundamentals are picking up as well. Realizations, I'm going to skip a couple of these. This one is important. So this is the quarterly realization trend for our fund, going back a few years, going back to 2016. Firstly, we're illustrating in the green bars, the fourth quarter of each year is the strongest. On average, 35% of the cash comes in the fourth quarter as managers try to meet their year-end targets and drive their numbers. So we've seen a pickup in Q3 this year. Perhaps Q4 will be particularly strong as the industry continues to recover. Uplifts to carrying value on exit. We have seen, going back more than 10 years now, a typical gain when we realize portfolio companies of between 30 and 50%. So the more realizations we see, generally the better NAV per share performs because we're crystallizing that value in an uplift to the book value. You'll see the spike in 2021. That was a historic moment, unlikely to be repeated, with venture IPOs tripling and quadrupling overnight. Sadly, those days are gone, but we are back in 2024 in the first half. We're back to the long-run average of around 30% uplifts. So in conclusion, I think we're well positioned. This chart shows you the rebased NAV per share price and the index. NAV per share being the top line. Essentially, we're waiting for the shares to catch up with where the portfolio is. We've seen 2.5 years of resilience in the face of major global upheavals, particularly with the interest rate move. But the portfolio has been revalued many times. It's been audited many times. We are confident in the NAV. The share price has underperformed for many reasons, notably negative sentiments in the UK, challenges around the investment trust market driven by capital gains tax motivated selling ahead of the budget, We've had a confusion over cost disclosure rules, which continues. I mean, it's a net positive change, but there's still confusion. So I think fundamentally the problem is liquidity in the market for investment trust shares, and I think we are one of the victims of that. Our distribution pool should help, and we're certainly doing all we can in terms of promotion, which is part of the reason I'm here, of course, to tell the story and hopefully win over some new buyers. So with that, I'll take any questions if we are. No, we're not. Okay. That's probably a good thing.